Hey, we're gonna get started. I think we've been quite generous, 2 minutes. We'll get straight in. So thank you everyone so much for joining. Please use the chat box to say hello. We have an action-packed hour. So first up, we'll have Aud at 60 decibels with a quick presentation of the key insights from this new research for you. Then onto a discussion with two expert speakers and one or two others I've teed up. I'll introduce them a little later. I'm going to try and keep us really on track to ensure we have plenty of time for Q&A discussion with all of you. And maybe I should do a quick intro first. I think you're familiar, most of you, with us, but 60 decibels are an impact measurement and customer insights company. We really focus on capturing and amplifying stakeholder voices and experiences, mostly through our incredible network of 1,600 plus research assistants across 95 countries of the globe. You might have seen some of our social impact benchmarks, which help put things into context. And this is a pretty nice report we've just put in the chat, I think, to our Why Off-Grid Energy Matters. Thank you so much. Which gives a really nice overview of lots of the things we know about the impacts of energy access from a customer perspective. Just before we dig in, please use the Q&A box rather than the chat box if you can to post any questions. You can do that throughout the hour, and we'll get to those a little later on. We're recording this webinar, as I mentioned. We'll send you the link afterwards, so if you want to share with any colleagues or look back at anything. And now straight into one of the interesting parts. Over to Aud to talk us through some of the most the key insights from this recent work, talking to defaulted customers who've had their energy access taken away. Over to you, Aud.
Thank you, Kat, and hi everyone. It's good to be here with you today. We're going to be looking at our Falling Behind report, which set out to understand the experiences of defaulted customers. So these are customers who lost their energy access through product repossession, locking, removal, voluntary return, or other factors. We spoke to over 1,400 respondents across 5 countries: Nigeria, Kenya, Malawi, Côte d'Ivoire, Sierra Leone, and we got data from 10 organizations. Thank you so much, Paul, who's also here, for their participation in this. And we were able to really gather rich insights to understand the experiences of these customers. To structure the insights, we focused on 4 key questions, and I'll be taking you through each of them. And the first question we wanted to really understand is, who are defaulting customers and how do they compare to active customers? And as you see from this page, in terms of demographics, defaulted and active customers have quite similar characteristics in terms of age, household size, where they reside, so whether they live in a rural area, peri-urban or urban area, and also in terms of gender. But we did note a couple of differences. So the first thing that we saw here was that 42% of defaulted customers live below the poverty line, as compared to 52% of active customers, which seems surprising, counterintuitive. But you can imagine that, for lower income household, they might not even have access to credit facilities in the first place, and so they're not necessarily always signing up for things that will require loan repayment. And also in terms of, conversely, if you think about higher income households, they have competing priorities, and in terms of financial obligations, which might potentially lead to default, as is the case with the people we spoke to. Another area of difference came around household consumption. So we see that defaulted customers are more likely to say that they have cut back on household food consumption, which is really a key sign of financial distress for this group of people. So if you look at the comparison, it's 41 to 23. So it is quite a bit of a difference in terms of how these customers are experiencing affordability and over-indebtedness as a result of the loan that they took on. Now, this is also another key area, and at 60 decibels, as you know, we are all about improving customer experience, improving customer satisfaction. That is really our goal, supporting organizations to do that. And here we do see quite drastic differences in terms of experience. So the first thing we see that in terms of challenge rates, so this is just challenge rates related to the product itself, as opposed to, paying for the loan and other factors that might come into play. In terms of customer experience, we see that defaulted customers reports a higher challenge rate as compared to active customers. So that is over half, so 56% compared to 36%. And then in terms of those who said that their issue was resolved or not before the product removal, we see that defaulted customers also have a lower rate of issue resolution. So this means that most of them have their issues unresolved. So this is almost 9 in 10 customers saying that they did not have their issue resolved before they had their products locked, repossessed, and others. And of course, it's not surprising that we see that in terms of satisfaction, the defaulted customers have a lower NPS score, so -3. So the score ranges from -100 to 100. And so we see here -3 as compared to +59 of active customers. Moving on to the next insights, we wanted to understand how well do customers understand their contracts and payment terms, because this is a key aspect in terms of consumer protection, customers knowing what exactly they're signing up for before committing financially to something. And we see already from this that in terms of consumer protection experiences, defaulted customers have a score of 51% compared to 65% of active customers. And I'm going to just tell you a little bit about what we mean by this. So in terms of consumer protection, these are average of 3 themes that we use to assess the experiences of customers. So one of the key areas we look at is awareness of key terms. So customers really and assessing whether customers understand some of the conditions, terms that will be relevant for them to ensure that they are staying on top of payments. And already we do see a difference here between defaulted customers and active customers. And the second theme here under the consumer protection is ability to pay. This is really our way of assessing the affordability of some of these products and services and the risk of over-indebtedness for our customers. And we see here that we see quite a drastic differences between the ability to pay for defaulted customers as compared to active customers. And then the third theme here is ease of use. And this is really around how easy is it for a product to use, how easy is it for a product to be navigated by your customers. And of course, it affects the benefits they're able to derive from the products. It affects their customer experience and satisfaction. And here again, we do see that there is, just in general, I think is one of the things if you haven't read Why Off-Grid Energy Matters report, please go read it. But this is an area, our biggest recommendation is a focus for companies on ease of use and really trying to reduce those challenges that customers face. So you can still see, even with active customers, it's still a bit low, but we can see it's much lower for defaulted customers. And so in terms of generally like consumer protection, we do see that here defaulted customers are definitely experiencing have worse experience compared to active customers. The third insight, we wanted to understand what processes are companies undertaking during products removal and how did customers experience this process. So the first thing we asked the customers is whether there were multiple steps involved before the repossession happened. And you can see here about 2 in 5 reporting that there weren't any steps taken, multiple steps taken by company before the product was taken away from them. And then we just wanted to also understand how did they feel about the process. So this is the product removal, and we just simply asked, did you find the outcome to be fair or unfair? And again, here we see that majority of them, almost 3 in 4, saying that they found the process to be unfair. And this really speaks to some of the insights we got in terms of the qualitative responses about the situation. And it was really coupled with emotional distress, a sense of financial loss, because customers will say, I have paid for the product for a couple of months and I had to miss one payment and I couldn't make the payment 1 time, 2 times, and now the product is taken away and they're not really able to get like a reimbursement or a refund for the payments that they've already made. And then we have some people who just express dissatisfaction with the product, with the process. In fact, we have 1 in 10 of customers who said that they face mistreatment at some point. So the agents either discriminated them, used abusive language. And so you really see that beyond just, it is companies need to take steps because of course, customers signed up for products, and if they, they haven't paid for the product, companies, can take it back. But that process of taking it back, ensuring that customers experiencing it in a way that, makes them feel respected, is quite important for us to, as a recommendation to the companies. And then the 4th insight we really wanted to understand is what happens after default. So what happens to these customers who at different points they had access to solar home systems, appliances, and then because of lack of payment, they do not have any access. Are they better off than they were before? Are they at the same level, or are they worse off? And we see here that the majority of defaulted customers are back to pre-purchase energy access level. So in fact, we have 26% who are better off than before. So how we compare this is to just really looking at that energy ladder, thinking about the energy ladder and whether customers have gone up the energy ladder, whether they are at the same level or they're worse off than before. And so this is, I guess, in a way, good news that most of them are at the same level and not worse off, because our main concern when we started out this study is really seeing a majority of them even worse off than before. But still, there are experiences of customers in terms of emotional distress, in terms of that sense of financial loss, and really the lack of trust that it creates, like the process of product removal sometimes creates with the companies, that we need to look at. And so rounding up, these are some of our ideas for action based on customer voices, of course. And one of the things that we recommend companies looking at is strengthening their onboarding and financial literacy support. And this is because, as I've mentioned, one of the key aspects of consumer protection is really ensuring that customers understand what exactly they're signing up for. And we did see gaps in defaulted customers, saying that some companies did not check for their understanding of key terms. We also saw that they expressed lower awareness of like contract length compared to their active counterparts. And then also key to mention here is that rural customers also seem to be experiencing worse experience in this regards, and it might be perhaps because of the cost it takes to just like reach customers in remote areas, or also just the lack of monitoring of agents and how this some of the financial practices and policies within the company is actually actioned on. And the second thing is looking at just that repossession process. Are there ways to improve the experience of customers at that point, ensuring that they feel respected, ensuring that there are multiple engagements before a product is, repossessed. It should not be a surprise to to your customer that the product is being taken away. They need to understand why exactly it's being taken away, and also just understand what are the next steps after, right? Is there a way for them to get the products back so that that sense of financial loss might, be reduced? And then the third thing here is in terms of improving affordability measures and payment flexibility. we heard from customers that, you know, affordability and was one of the areas they struggled with, especially for expenses that just came up, unexpected expenses. And so this is one of the ways we recommend companies to assess and look at that customer experience and try to support them in terms of like, you know, payment flexibility, whether it's a payment holiday or when in moments where an expense comes up, that might mean that a customer is not able to pay 1 round or 2 rounds. Are there ways that, you know, we can support customers to ensure they still have a good experience and they don't lose their energy access? And the fourth thing here is around product reliability and after sales support. As I've seen here, product usage is really a key stressor for some of these customers. Some of them just simply stop paying because they said, I can't pay for a product that I cannot use. And this is, no one wants to pay for a product they cannot use. So trying to ensure that we are refining that customer resolution process, trying to ensure we are looking at how issues can be resolved in an efficient and more effective way will really go a long way here. And then lastly is develop responsible post-default recovery pathways. And so this is really to the sector, ensuring that we are, you know, monitoring what happens when customers lose access to their energy products. Are there ways that, you know, we can ensure that they still have, you know, access, whether that is low specs products, if they had like a, you know, a higher product, low specs product that they can possibly afford? Is there any something we can do in terms of like product trade-in? So there are some ideas that we have in the report. There's more in the report that we think that will improve customer experience and of course ensure companies are able to reduce that credit risk for themselves. So over to you, Kat.
Awesome. Thank you so much, Aud, for walking us through the summary. As Aud said, please do check out the report in full if you haven't already seen. There's lots more insights in there. Aud just did an awesome job of the summary. So the link's in the chat just now. And at this stage, I want to say thank you so much to the 10 companies who participated, who trusted us to talk to your past customers. I know a lot of you are on the call, so I'd love you to be part of the Q&A and discussion coming up. Baobab Plus participating in this research. We've got Paul Bessala, CEO of Baobab Plus Côte d'Ivoire, here to talk with us about consumer financing and what the company are thinking about and doing. So firstly, Paul, do you want to give us a quick intro?
Yeah, sure. Thanks, Kat. I think first of all, I would like to thank you about what you did, your work, and the invitation to participate to this webinar. I think it's always interesting to have a time to reflect what is happening and how you can assess what you need to change to improve things. So thanks for your work and taking the time to discuss with our customer. Hi, everyone, also for joining, and I hope that you have a very good insight for what we are doing at Baobab Plus, but all over the industry. My name is Paul Bessala. I'm the CEO of Baobab Plus Côte d'Ivoire. Before joining Baobab Plus, I spent 7 exciting years at Jumia, helping shape the e-commerce landscape in West Africa, especially. I then moved to the energy access space with Peg Africa, which later became part of Bbox. So I know a little bit about the stories, you know, the Pego industry. And, you know, across these roles, one thing has remained constant: my passion for using technology to drive real lasting impact. At Baobab Plus, we are on a mission to bring clean energy, digital solutions to underserved communities. In Côte d'Ivoire, especially, that means helping thousands of families power their homes, connect to the digital world, and unlock new opportunities. As CEO, I focus on scaling our impact sustainably with a great local team and strong partnership, because we believe access to energy and technology is a foundation for inclusive growth.
Awesome. Thank you so much for being here. And we've also got Rebecca Rhodes, Senior Strategy and Programs Manager at GOGLA. Do you want to say hello?
Hi, Kat, and thanks to you and Audrey for having me, and great to be part of the discussion today. So I also see many GOGLA members on the call, which is great. But for those who don't know us, GOGLA, we're the industry association for the off-grid solar sector, and our work cuts across the sphere of access to finance, regulatory environment, and standards and good practice for companies. So as part of the latter, I've been working on consumer protection at GOGLA since I joined 5 years ago, which for me was a bit of a transition from actually managing defaulting customers and working on credit risk management strategies for an off-grid solar company in Tanzania. So I have some of the battle scars that comes with that, and then transitioning that to moving towards building the standards and the tools and resources for the wider sector as well. And I think we'll get to it a little bit more detail later on, but GOGLA, we built the Consumer Protection Code back in 2018 just to ensure that, on the one hand, we really are safeguarding the rights and outcomes for consumers, but on the other, we've got companies that are able and equipped to build a sustainable business, because ultimately we know that, and we have the data now, thanks to the insights from Audrey, that satisfied customers are more likely to pay for their energy services. It's simple as that.
Nice, thank you. We're actually going to start with you because you're going to help frame, and I think hopefully everyone on the call is here because they know the why, but Rebecca, I know GOGLA are working with companies in several areas that affect consumer experience. Why is this an important area for the sector to focus on?
Yeah, so I think, like I said, we've been building this kind of suite of knowledge around what does good look like for off-grid solar companies, and for a few years. We know that we're serving, really vulnerable, poor communities, rural communities. And so the need to really mitigate kind of financial risks, product risks and service risks that come with that, particularly where you're extending credit as well through the PAYGO models or other asset financing models. It's really important that companies take on board that kind of best practice and build responsibility into their models. But, over the last few years, we've really kind of been able to scratch a little bit beneath the surface as well, and look at some of the impact of these different practices on consumer outcomes. And I think we've learned, I'm going to say, top 3 things. So the first is that the first 3 months of a customer's journey with that off-grid solar product is really critical and the most influential to the end outcome. Second, there's a big range in the sector of performance when it comes to consumer protection and credit risk management. So some companies, they've figured it out, they're doing great, and some still have room to improve. But there's also these areas where actually across the board, there's room to improve. And so we're here to kind of support the industry, find out what those gaps are and keep building and keep improving. And I do think the industry has come a long way. But, we're still seeing kind of these sticky issues, a bit like the challenge rate that never really seems to reduce in your data. So I think it's really important that as a sector, we improve, we focus on the actions that at a customer level, company level, and an investor level we need to take and all work together. And the consumer experience is a way that kind of brings all these different pieces together. So we've got consumer protection, credit risk management, portfolio quality, but also things that investors do, like setting the right KPIs and supporting companies through capacity building. So I'll leave it there.
Beautiful, thank you. And I think we all agreed on the why. We also know that the delivery on the ground can be challenging, exactly as you said, Rebecca. Like, some companies are doing amazingly, some are struggling a bit, and there's definitely quite a range. So Paul, maybe you can share a bit about, like, what are some of the main challenges you face delivering consumer financing to lower income customers, because it's a difficult market?
I think the word difficult is maybe like gentle. It could be tough. And yeah, I think, well, if you start looking globally or generally speaking, each country, each market, each product or each company has its specificity, has its particularity, how to operate. But I think looking at the fundamental of the PAYGO, what you said, delivering customers, financing to lower income customer is definitely challenging. I think one of the main challenges is assessing creditworthiness in the absence of formal financial histories or documentation. As you know, I think many of our customers are unbanked and work in the formal sector, which requires us to develop alternative credit scoring models based on behavioral data. Another challenge is ensuring affordability. I think Rebecca mentioned it. Product must be high quality, but still accessible through flexible payment plans. On top of that, we can add building trust within communities and ensuring consistent repayment in remote areas where infrastructure may be limited, also requires strong local presence and the customer support. You mentioned it also in your report. Lastly, the financial literacy remains a key hurdle, so we can integrate education as part of our approach. I think this is what I can say. Maybe there are still other challenges, but the main ones could be those I've listed.
That's great. Yeah, so we know what the targets are, but we know now also why it's not always that easy to make sure 100% of customers are satisfied 100% of the time. Rebecca, now feels like it might be a good time to bring in some other new insights. So some of you here today may have joined the GOGLA webinar last week, sharing the new Altai Consulting research, talking to defaulting customers. So now there's a really nice set of insights now on companies' consumer financing processes, active customers' experiences, defaulting customers' journey, and lastly, what we're talking about today, the defaulted and past customers. I think we've just put a link in the chat to kind of a suite of these reports. And I suppose, spoiler alert, this messaging there's some quite clear messages coming through. But Rebecca, do you want to share a little bit about the key insights from that to tie all of this together?
Yeah, sure. I'll also post a link to the study and the recording from that webinar as well. So I think lots of people would be interested in tying the two together as well. So the study that we did with Altai, it's funded by NDEV and Avia, and we looked across 3 companies in 2 countries, Kenya and Uganda. We tried to tie customer information with company practices and make the links between those as well. And the customer segment was still active customers, but those who had missed payments. So that they're, as Kat said, defaulting. But that could be, you know, we've missed a third of all payments within the first few months, or, you know, just a week or so. So one thing that we learned was even with active customers, they miss payments because of unstable incomes or sudden financial shocks, so caused by climate events or medical bills, for example. So I think we need to assume that it's a given in our target customer base for a large proportion of the off-grid solar market. Those customers will experience financial constraints and insecurity at some point during that repayment term. What seems to make the difference is how the company then responds to that. So might be having better ability to pay assessments upfront, which kind of really understand the nuances of irregular incomes and can assess that properly against affordability, or supportive restructuring of payment plans if a customer really is struggling and needs to kind of reset. So yeah, so there's a lot of, you know, some things we can't avoid, but we can change how we respond to it and the models that support that as well. The second is that in both studies, there's this issue of technical problems that comes up in quite high numbers. One thing that stood out to me in the Keeping the Lights On study is that differed quite a lot between countries, even when the product range was the same. So I think we can't automatically think that that's a technical issue, and we need to look at customer education, how we train our agents to then train customers in using the system, and then how do we build the relationship with customers so that they can access after-sales services and the support that they need. I think the final point I would make is that I think all of the data is underpinning that we need to measure success, not on the kind of upfront connections, but seems to be the easier part, but actually keeping the customers happy and satisfied and paying for the energy. And I think we are starting to see this shift now in the sector as well, which is really great. And studies like all of these different pieces we've got fitting together at the moment are helping that.
Nice, thank you. Yeah, quality, not just quantity. And we're going to come to Pigo Labs in a second, actually. But I've got one more question for you each. Paul, yours is quite a meaty one. But thanks for being part of the research, letting us talk to your customers. I'd love to hear, what did you learn from the insights from this work, either from the work we did with you specifically or this broader report everyone's seeing? What was surprising, what was validating? And then linked to that, so two meaty questions. What are you working on now? Are there any actions that Baobab Plus has taken or will take from these insights? What ideas do you have maybe that other companies could replicate or could consider delivering on?
Thanks for the question. I think Rebecca already mentioned a lot of things, interesting things that the report is showing up. And the report is more about validating what we learn from our mistakes. Let's call it like that way, because it's the reality. The report is showing that many of our customers, they are facing some challenges that we couldn't address properly, and that means we made some mistakes. And I think the report is clearly validating that. And if we need to recap it, I think the customer is the key of everything. Yes, you have the product, you have the sales team or the team, you have the way of operating, but definitely the customer is the key of everything. We need to have a personalized approach for each of our customers. That's a lot. I know it's a lot of work, but at the end of the day, what is better, selling 1,000 kits and being able to get repaid for only 200, or selling 200 kits that could be repaid fully? I think most of us have the answer. And we need that personalized approach. We need to be able to manage that from the customer selection at the entry. Who are we selling the product? Why? Is the need concretely real? Is the customer being able to pay a minimum amount linked to the product we are selling? If it's not, you need to address or propose another product, and so on and so on. And this is something you need to manage all along during the life cycle in your portfolio without missing the quality of the service. If the customer has a challenge, you should be present super fast to react, to be able to anticipate, to fix that. Going to the question, what are any action that Baobab Plus has taken? We had a chance to work with Pigo Lab, and after the customer selection, we are now working on, as Rebecca mentioned, if the customer, let's assume that the perfect customer being able to be happy to use your product, being able to repay, but they can face an unpredictable issues. They can fall sick, they can have, whatever that you couldn't predict. How do you manage that? And you need to be very close, super close to them. And that's why we are now working on a restructuring approach of their outstanding balance. If they have a specific issues that we can, we can confirm through their existing repayment model, how they have acted during their life cycle. And now we can propose an approach where they say, okay, as you are not able to pay now because you have an issue, how could be the best? Maybe we can say, okay, we start to pay at that time. You reduce our minimum payment. You can we think about how to personalize it. Also taking into account the reality of what they are living. There are some reality that you see, okay, it will take long to be fixed. Maybe it will not be a good approach. And after that, the idea is to push the customer to say, okay, at the end of the day, looking at whatever we look together, I think I will not be able to continue to repay your product. Let's find a solution to move out from it. And this is the next level, how we can manage the customer to be part of the process of the repossession. And that would be different. We saw during your report that some of the customers were feeling that they were frustrated, there was no communication, so on. So we are trying to change that based on the kind of feedback your report stated, and this is what we are working on. We really hope to improve again our risk management and customer experience mainly through that process.
Love it. I love it, Paul. The customer's key. In fact, probably none of us on this call would have a job if it wasn't for the people we're trying to work with. I'm gonna tee. You mentioned Paygo Lab, Paul, so we're gonna tee up Alex. Hope you don't mind. He's hopefully gonna join on the screen. But Rebecca, over to you. So we know customers are key. We know that we've got these amazing companies out there making a difference, but also, as Paul really honestly and openly said, making mistakes. We all do, but we're learning from them too. Rebecca, what are GOGLA doing to support sector stakeholders like Paul and Baobab Plus in really ensuring customer protection practices are upheld and that customers are safe and well?
So I'll start with the first thing I tell everyone, and it's that we really do encourage every company to adopt the Consumer Protection Code, because it gives companies a framework to really understand, how are they performing, how are they kind of serving customers across 6 key areas that really do impact the kind of the customer's experience of the product and the service. And it also gives kind of through the indicators, the kind of practices that, should be expected and the service that any customer should expect. So that would be number 1. The second is, in the last few years, and Kat, full well, we've been working together to develop more services to help companies look at what gaps they have and really kind of apply a more objective lens on how they're performing against the Consumer Protection Code. So with 60 Decibels, we developed a consumer protection module for their lean data surveys, and that informs the consumer protection score. And we're hoping that as more and more companies can take this up, we'll be able to see, how individual companies can kind of assess themselves against the sector benchmark as well, which we've set last year at 68%, I think it is, for consumer protection as a sector. And then companies that want a more in-depth rigorous assessment can undertake a third-party assessment with MFR, and this is really an independent view of practices, policies, and operational model as well. So, and then finally, we are currently working on an update to the Consumer Protection Code, breaking news, to make sure that it stays relevant to like emerging risks. We've done some work recently on looking at new risks that might come up in productive use sectors, so the irrigation and cooling sectors, which is slightly different. And so we're making sure that the code stays relevant, stays up to date. And we're also setting a version of core indicators, which we hope will help smaller companies adopt the most important practices within the code. And investors will know if companies are doing those sort of 10 or 12 bare minimum things good enough.
Nice. Love it. Thank you. Rebecca, Paul, thank you so much. Don't go anywhere. We've got loads of questions. I can see them coming up. But now, Alex, thanks for joining us on the stage. Alex is working at Paygo Lab, which you heard Paul talk about. And I think many of us read Dan and Willem's article in Next Billion on some of their insights. And there's some really clear messaging emerging from all of this work. There were some great recommendations for companies and investors in that article as well. I think we're just going to pop the link to the article in the chat. So Alex, would you be up for telling us a bit about what you're doing at Paygo Lab and what you're learning?
Yeah, thank you very much. Thank you, Kate, for hosting us. It's a pleasure to be here today. So my name is Alex Galissier. I'm the head of R&D and co-founder of the Paygo Lab alongside Willem Nollens and Dan Murphy, who authored the article of Next Billion. Some of you may already know us. At Paygo Lab, we're a team of like seasoned practitioners with extensive leadership experience in either the Paygo sector or microfinance. And so we've been on the ground learning and implementing effective credit management. And the reason we founded the Paygo Lab about 2 years ago is that we felt that the Paygo sector was really facing repayment and credit challenges, which was impacting companies, but customers alike. And so our mission has been to support companies in improving their credit management. We've achieved that through two main approaches. The first one is really providing an unbiased and transparent review of company performance through our analytics engine. But the second and more important one is we offer direct operational support to companies to enhance their credit performance, for example, to Baobab Plus in Côte d'Ivoire. And our approach is really guided by two key principles, which we'll talk a bit more about. The first one is really the dual nature of pay-go company and the fact that we need to acknowledge that pay-go company are both selling a physical product and a financial product, and this need to be reflected in your organization and management. But the second principle, and it's actually more related to the talk today, is from our research and from all the numbers we've seen, and we've studied over 4 million pay-go contracts to date, we've seen that customers don't change in average. That means customers who are over-financed or who do not really understand the nature of contracts tend to default. And the opposite is true. Customers who tend to really pay their installments since the onset and have, say, good repayment performance within the first 2 or 3 months, the vast majority will pay very well, even amidst external shocks such as COVID, et cetera, et cetera. And so really one of the key recommendations is, as you mentioned, properly assess customer, properly deep dive on customer to understand their risk profile, whether they're able to afford the kit, et cetera, et cetera. Because if you don't do so, you won't be able actually to support customer who will face an issue later down the line. You will really sort of clutter your follow-up process. So I mean, we tell a bit more in the next billion paper, and we're really committed to sharing more of our knowledge in the coming month. I don't want to take too much time today and leave space for the questions, but always feel free to reach out to us if you want to discuss, learn more about our insights, or get support. So to date, we've supported over 35 companies in 17 countries and over 10 investment funds. And yeah, we're looking forward to doing more in the future.
Awesome. Thank you so much, Alex.
Thank you very
Okay,
much.
so we're going to jump to Q&A. Please do reach out to Alex or ping him in the chat if you do have more questions, and I'm sure some of them will come up. We received quite a few questions during the registration process. We're going to do our best to go through as many of them as possible, though I think hopefully some are answered through the last, 30, 40 minutes. We'll try and respond on all unanswered questions in a follow-up email too. We'll send you an email with a link to the recording. So we might not get to them all, but let's give it a go. If you'd like to respond to a question, because there's lots of experts on the call too, not just on the screen that you see now, I think you can put your hand up and we'll get you unmuted and on video. We'd love to have this as interactive as possible, but obviously there's lots of people. So the first one, Aud's going to help me. Where is she? Help me manage all the questions, but I'm going to start with one or two that we had kind of in the pocket already. Rebecca, we don't see Oliver, so I'm going to you. One question we had, and it's kind of a simple one and hopefully a framing one, but you can punt it to a follow-up email if you don't know the number. But somebody had asked, what's the proportion of defaults? What's the scale of the issue that we're looking at?
So I'm actually going to refer, because I have asked this question, I knew it was coming. We, through the pay-go perform metrics, and we collect data from around 80% of the market across our members. We have a KPI of, it's not default because every company measures default differently currently. So we use the receivables at risk 30. So this is customers that haven't paid in the last 30 days plus write-offs ratio. It's around 25 to 30%, depending on when and where you look. I'd actually say that PagoLab also have data, which is a slightly different company set as well, and a slightly different view through looking at the KPI, which is the number of customers that actually don't have access to their energy products on every given day. But in a roundabout way, yeah, about 30%.
You did great. Thank you. Okay, or get a question ready. I've got one I'm going to put out. Paul, I'd love you to start with this one, but we might tip it over to John Keane, who I see on the call, if you're up for it. Because I think there's a broader story here. So, Paul, to you first. What customer experience should be offered to populations with irregular incomes, where like regular payments might be difficult? And somebody's asked, how do I sell to someone who can't afford to pay me back?
I think that's the main question when you start doing pay-go business. I think I remember when I joined the space, I was as a finance buyer, having a finance buyer, I was like, how is it possible? Like how someone thought about that kind of business. But at the end of the day, there's much more about people, the social impact and so on. And maybe to answer, I think I will just share what we are doing. We are trying to do at Baobab Plus. Today, they are maybe as PayGoLab supporters, and Alex was explaining, are we sure that we are selling the product to the right person? Maybe there are some that they are in a minimum of payments that can be able to afford the products they want to take. Are we selling the right product to the right person? Someone can, they are in the same village, but someone can repay for a TV, someone can just take the SHS. But sometimes because they are seeing their brother or their neighbor taking a TV, they also want a TV. So you need to properly assess what is the real need, how is the real ability of the customer to be able to repay. This is the first thing. The second thing would be how much or how many times are you in touch with the customer? And this is another level. Sometimes when you sell a product, you think, okay, we did the biggest one, we'll wait until maybe it will be default, it will be defaulted, or maybe we have an issue or something like that. We'll try to connect. So having regular point of contact with your customer, even without a necessary need, like not having an issue or not just because he has to repay you, just to take some news from you. Is it going well? Do you have any issue? How can we support? Do you know how to repay? Do you know that the engagement you took when you took the product was for a certain number of time? Do you need anything from us? How can we support? And so on and so on. So we have at Baobab different steps, like we call after the vetting call, we have the welcome call 1, the welcome call 2, and now during that call, there are different questions that we can collect data from the customer and be able to anticipate, to predict a little bit what will happen with this customer. That's what he's saying, that he was not clear about the plan, the payment plan, which is not correct, because we remember during the vetting call, we asked him, are you aware about how many times you need to pay out? What is the minimum? So you need to collect the maximum of data to be able to anticipate. And the third point is to always ensure that if the customer has an issue, you need to be there. That's why also having as much as possible number of point of contact with the customer will help you to anticipate. Oh, because sometimes they know that they have to call you, but oh, maybe I was not having airtime to call you. Maybe I was not having network. Yeah, I have an issue with my brother. So you can anticipate and solve that before they be in default. And lastly is when you make sure during the 3 months, as Rebecca mentioned, that the customer is clearly understanding the idea of your product, if the need is real, is using the usage rate is correct, is repaying you a minimum amount correctly on a regular basis. Maybe he can fall default, but he quickly repay you. That means it's a good customer. And this is why we put also a classification about our customer, like having a good customer and a bad customer, A, B, C, D. And as soon as a customer is classified, you know exactly what would be the next step with that customer. A customer A, B doesn't need to be re-educated. It just needs to be ensured that the product is working perfectly. Or a customer C, D, we need to understand what is happening and why it's being so much in default. And you act in consequence. You need to adjust what is needed to adjust. And as soon as that 3 months is over, now we enter to what I've mentioned earlier. If they have an issue that was not predictable, okay, how can we act? How can we adjust our payment plan to make sure that we continue to be able to repay? It was maybe a customer E becoming gradually a customer C, D, because he had issue. So we need to fix it and make sure that it go back to the right class, the right place. Or he was always a bad customer, and adding that unpredictable issue will not probably help you more. So you need to now start working on how to move out that customer to manage that. And I think this overall kind of customer experience we need to have. It's still some room for improvement, but I believe as we are seeing a very improvement on our side of the numbers, on the cost of risk, on the repayment, on the classification, just to give you a sense of numbers. Back in the time 1 year ago, we were having 30% of our customers classified as Class D. And today we were able to reduce it by 1/3. So we have 10% of our customers that are classified as Class D, and we see a grow on a Class E or B, because we are now making sure that each cohort, we are improving our customer selection, we are monitoring closely actions and what could happen with the customer, and taking right action for the right problem at the right time. So this is a little bit what I can share, and with a practical exercise, what we are doing at Baobab Plus, with some good results we are seeing on our portfolio.
Beautiful. Thank you, Paul. And I'm coming to you in a second, Rebecca, because I was teasing you with John Keane, but I think technology may have failed us. But one of the parts of the question we're going to answer around, I can see a question in the Q&A around, are there other models that are better suited perhaps to reduce default rate? And I think energy as a service versus pay-go is a kind of a new take on a kind of a model that's been around for a while, and I think there's a lot of exploration of whether this can reduce some of those credit risks and exactly still provide solutions to customers who don't have access. I think to answer the first part of that question, so we've asked, the question says, do we have enough insights to understand what proportion of customers might be better suited to energy as a service versus pay-go? I think the answer is energy as a service in its new phase. There isn't sufficient evidence for us to know lots about the profile of those customers and how that access impacts them financially and from a social perspective. But Rebecca, the second part of the question, so I wonder whether you want to speak from the kind of industry level. Are there other models that we need to be looking at to provide access but reducing these kind of default rates and credit risk?
Yeah. So actually one thing that stands out is the use of subsidies. So, you know, we're looking sometimes at a commercial market, a concessional market, and a subsidized market. And you know, I think there's a need for the sector to really kind of segment customers into those brackets and really target support where it's most needed. One of the inevitable things, if you improve credit risk management, is that essentially you might say no to more people, but on a commercial basis. But actually, if you have the tools and subsidies that will allow you then to maintain you know, service and sales to those people, then you kind of fill that gap as well. So I think one of the areas that we want to actually look more at in the next phase of the keeping the lights on is how subsidies actually impact you know, that customer experience and the kind of payment journey of customers, so that then subsidy designers in future can create programs that really respond to this and create long-lasting connections and impact as well.
Love it. Thank you. Now, Paul and Rebecca, have a look at the Q&A. Pick one you might want to answer. To now, Aud, I'm going to you. Pick us a question.
So the question that I want us to answer is around the sorry. Just a sec. I seem to have lost it because I was answering another question. Yeah, so sorry.
So me to pick one?
Yes. Yes, so given the country-specific problems that you observe, I think this is Rebecca talking about their differences by country. Are the figures also more of some appliance-specific? Are there some specific appliances that you see much of consumer ignorance leading to lots of issues, and could these problems rather than appliance durability, or do you think it's more of a consumer ignorance issue?
I'm gonna pass that one to Paul, actually, from his experience in the field.
Maybe can you say it again, the question? Sorry, I have missed some parts. Sorry.
Yeah, so given the country-specific problems that you observe, are the figures also more of appliance-specific? And I don't know, I'm guessing this is more like product-specific. Do you see certain appliances where you see more of consumer ignorance leading to more issues rather than the issues of like technical issues with the appliance itself? So it's like more consumer ignorance, and I'm guessing just like lack of awareness, perhaps.
I think I would say yes. Sometimes if you have a too technical product, let's assume a cooling product or maybe a mini generator or something like that, it will be always different than having SHS, which is quite simple, which is less complicated. And I think that's why the customer education is also key. Going back to that point of contact, there's always a need to refresh understanding of the product. That like simple question. Are you able to turn it on easily? Do you need to be explain something that you probably we did it, but we feel like it's too complicated. So once again, yes, we can have different issues looking at the product, but that's why we need to have always a kind of education trainings with field team, or maybe a call center where you have the customer online, making sure that they understand properly the use of your product. But you have a challenge because some product will be quite difficult to use or will be much more specific than others. But overall, the same apply to all the products. So you need to educate your customer. They need to be really understanding the use of your product to be able to use it properly and then be happy and then repay it. So it's a kind of logic kind of what is happening. I don't know if I properly answered your question. So
yeah, I would agree with that. And just one short point. So in the research that we did on productive use and consumer protection, one of the big kind of points of action that came out of that is sometimes productive use appliances as a solar irrigation pump could be more technical and it's new technology to the customer. And so that consumer education at the start is really important, if not more important than with like more established technologies now as well.
Amazing. Okay, I've got one question that is to everyone, so you can answer in the chat if you have opinions. Paul and Rebecca, you have like 20 seconds and then we'll close it up. But I've seen a few questions relating to technology and AI, both the use of it, but also how we protect customers. So what's your like 20-second hot take on risks and benefits? And feel free, anyone else on the call, to pop any thoughts in the chat.
I was a great opportunity, but we need to manage the risk of bias if we're talking about it for credit risk management. Inherently, AI learns from human bias, and with reams of studies that credit risk decisions have bias in them. Women get turned away from credit much more frequently than men. So great opportunity, but let's learn out the bias, not bake it in.
Paul?
20 seconds. That's interesting. I think we already have some data that we can use, and we really believe that the technology is key on the next level where we can bring the sector. We shared a white paper. I don't know if a lot of you have seen it, but inside we mentioned it clearly that using data to be able to predict the future, predict your behavior of a customer will be key. So at Baobab, we are working on it definitely, but yeah, there's still a lot of working on how we can improve the data. But let's use what is already existing, like For example, how consistently a customer charges a solar home system or makes me co-payments, we can build alternative credit profile that are dynamic and more inclusive. So I think, yes, technology is key, and we are working definitely with that at Baobab.
Love it. Okay, I'm so sorry I failed. We're 1 minute over, but we were quite close. Thank you everyone for joining. We'll send a follow-up email with a link to this recording. We'll try and answer some of the questions, or we'll send you some links to any reports. A massive thank you to Paul and Rebecca. Thank you so much for sharing all your thoughts and ideas and all your experience. A big thanks to the 60 Decibels team and our wizards behind the scene helping us out. And mostly to everyone, the companies and everyone in the sector, for being part of this conversation and being open and transparent and finding a way forward together. More soon. Keep the questions and the conversations coming. Thank you so much.
Thanks, Kat, Aude, and Paul. Cheers.
Thank you all.
Everyone.